All right, well, thanks again, everyone, for coming today. I appreciate it. And for those who are watching the recording afterwards as well, I appreciate you taking your time. So today we're going to talk about real estate and real estate investing in particular, which is a lot like dating. You've got to find the right match. It takes some work to make it successful. You've got to put in effort to find the right kind of property, get to know it properly, get to know the area, where it's come from, what its potential is. And most of all, you've got to make sure that it's a good fit for your goals and your needs. And just like dating, there are some deal breakers to watch out for as well. A property with major flaws, or one that's not in the right neighborhood, or one that doesn't have the right kind of profile to fit your needs, still might look appealing at first, but it's likely to cause you a lot of headaches down the road. It's very, very important to choose wisely. And then you'll be on your way to a long and happy relationship with your real estate investments. So for those of you who don't know me, a very brief introduction about me, Norman Lowe. I am qualified with the Chartered Institute of Securities and Investments in London as a wealth manager in international wealth management specifically. I've been offshore for 23 years almost. This year we're 23. I'm part of the Lawson's, which is a Swiss-based advisory network, which has partnerships all over the world with licenses in Switzerland, the UAE, etc. I'm also, most importantly, a husband, father, and an avid sci-fi fan. So please do get in touch with me about those subjects as well, particularly the sci-fi. I can talk all day on that. But fortunately for you today, just real estate. So the purpose of what we're talking about today is educational. The reason why I do these free knowledge sharing sessions is to provide a bit of clarity, to clear up misconceptions, and to give you some food for thought. It's not a lecture. It's something I tend to finish up in about 15 minutes or so. It's not a comprehensive look at one particular aspect of an asset usually as well. But in the end, you should come away with broader knowledge of property in general, and most importantly, what options are available to you. You should also have an idea about the pros and cons. That's really what this is about today, and that's the title of the webinar, and also the risks and benefits accordingly, and different ways you can invest in property. So for myself personally, to touch on again a bit about myself, I've been selling my clients property, amongst other things, as part of my wealth management career for about 10 years now. Mostly in the UK, because that's where a lot of my clients are from or where they want to go, but also increasingly I see the US, and I'm starting to get to people who are looking here in the UAE as well. So I work in partnership with real estate experts, which I vet very carefully before I make any recommendations. Being a financial planner means that I can, with all due respect to real estate agents, give a bit more of a holistic approach to on the property purchasing process. It's a fantastic quote here from President Roosevelt, which I always like, which I'll leave on the screen there for a second. It's a psychologically comforting asset. Everyone buys property, or almost everyone. Many people have made their money in property. And I'll show you some numbers as well about this, the global state of property, and also where high net worth individuals tend to invest their money. But the history of wealth is tied to land and vice versa. In most parts of the world, land represented status, rights, certain rewards throughout history. It provided sustenance. It made you more comfortable. It gave you a certain prestige. Land was often given as a reward for service to the state in ancient times. It was considered a great responsibility to own and manage land in the past. And this has left a legacy, and I think in our psyche, when it comes to real estate, we really view owning property as more than just simply another asset. You can have a massive stock portfolio that does very well, but it doesn't have the prestige, apart from obviously the numbers in your bank account, that perhaps owning lots of real estate would do. There are 4 reasons why you'd consider investing in real estate, I think. And there's 4 that keep coming up over and over again when I talk to my clients and prospective clients. First and foremost, it's a cash flow, cash cow, you could call it. It provides the most important aspect of investing, which is it brings in cash. When you're getting money for, I wouldn't say nothing, but for doing nothing, you own an asset and the money's coming in, you're ahead of the game. And for many people, it becomes a main source of income. Retiring on property or building a business around owning property and managing property is something we see all over, particularly here in Dubai. It's a proven business time and time again throughout many economies, many different types of government. Also, it survives all of that, with of course some exceptions, but generally any kind of smooth governance produces a very smooth ride with property. Property, when well considered, can also be a hedge against inflation. If you think about, for example, I'll use the UK because I know more about the UK property for direct ownership. The average yields are about 5 to 6%, depending where you look. You might get a bit more, a bit less. However, you've probably only put down 30% on your property. So you're getting, let's say, 4% on the whole value of the property, not on the money you've put down. So in real terms, you're actually making more like 10, 11, 12% on that property. So that's why it becomes quite a nice way to protect yourself against inflation for putting in as little as possible. It's also, of course, a real asset, psychologically very, very comforting. Bricks and mortar, land, you can see it, it's there, it's real, it's not simply numbers on a screen, it's a real thing. So the World Federation of Exchanges estimated at the end of December 2020, which was the peak of the pandemic, incidentally, that there were around $95 trillion of real estate exchanges globally, which is a phenomenal number. And I'll put that into a bit more perspective for you as well with another number from Savills Research. They estimate that the total value of real estate in the world, this is current as of last year, is around $280 trillion. Of course, they can't be 100% accurate in some markets, but it's around that, which is around 3 times the size of the global stock market. The global stock market is absolutely massive, so it gives you an idea of what the real estate markets globally are like. Most interestingly, and I like this because I like to see what the ultra wealthy are doing and the people who concentrate the wealth of them, what are they doing with their money? It's the second most popular asset class amongst the ultra high net worth individuals. And this is globally, this is not looking at any particular country, this is an average everywhere, but it averages around 29% of their total wealth. Before I go on further and I talk a little bit about the types of ways of investing into real estate and the pros and cons of each one, I want to be clear that today we're talking about real estate solely as an investment. It's not about where you're going to live. It's not a place perhaps you may even want to live. It may be a commercial property, an industrial property, not just residential. But the advice that underpins all of this is that you should always try to separate where you live from where you invest. You can make money on your property where you live, of course, many people do. But if you're looking solely at investments, separate the decision-making process entirely and look at what the market wants, because that's where you'll make your returns. So what are the ways of investing in real estate? There's certainly more than one way, and I'll go through the 3 main ways now. Direct ownership is, of course, the most common way of investing in real estate. It's what we all know. It's where you buy a house, you buy a unit somewhere, you buy a bit of land, whatever it is you're doing, you're buying directly, you're getting your title deed, you're probably putting some financing into it. So your tenant's paying most of your debt for you if you've picked the right kind of property with a good market, with a strong demand for rentals. And based on that, you'll get very good earnings continuously, which is often more important than getting high earnings. If you can get consistent earnings year in, year out, you'll end up usually with more money than people that are flying all over the place with double-digit returns one year, and then it goes down, then they've got 6 months without a tenant and all the drama that comes with that. And touching again on what I mentioned earlier, it's psychologically comforting. You own the property, it's yours. You've got the paperwork to prove it. There are some cons, though, when it comes to investing directly into real estate. Number one, it's not liquid. In most parts of the world, buying and selling real estate is not a quick transactional process. It certainly can't be compared to buying a stock or a share, which can be done usually on a daily, sometimes hourly basis or minute by minute. So when you're buying a property, whether it's land, an apartment, or whatever, you need to keep in mind that it's something that you aren't looking to sell quickly. Markets which allow selling quickly often end up becoming bubbles, as we saw in the UAE a number of years ago, and that actually ended up hurting the market quite badly. It hurts the reputation of the market. It causes a lot of inflation that shouldn't be there, and authorities generally after a while start to stamp down on it because it's not good all round. You've got another problem when you're buying directly, is that accessibility. You're limited by having lump sums of money to buy the property. If you have to put 30, 40% down on a property, even if you have to do that in staggered payments, it can still be quite a considerable sum of money for a property in most parts of the world. And then, of course, you've got financing as well. You've got to look at how do you finance the property. Are you fortunate enough to find a developer which will allow you to finance in-house, or do you have to go to the banks? These are things you need to look at very carefully. And if you are buying property directly, it's always a good idea to find a good mortgage broker who can give you an indicative rate before you start looking around. Because if you put your money down and then you find you can't get financing, you could put yourself into a position where you may lose money, or it may take a long time to get out of the deal. Lastly, and this is something I'm hearing a lot now from other parts of the world, particularly clients who own property in Europe and the UK, is finding and keeping good tenants. It's becoming harder and harder to do this, particularly as a private landlord in some parts of the world. There are often unfavorable laws being passed, which make it harder to even remove tenants that simply don't pay, that ruin your asset. So it's important to look at the legals of that, or to find other ways of investing where you can circumvent or mitigate those risks. So the second way of investing in property, I've included two things really as one, which is REITs, real estate investment trusts, and also crowdfunding. Now, these two overlap. Essentially, what you're doing with this is you're pooling assets together as a group, usually in a fund or some private app or crowdfunding system, and the people who run that will go out and buy real estate on your behalf. Now, the great thing about this is you don't have the hassles of ownership. You don't need to worry about getting financing. You don't need to worry about selecting the right property, because generally the people that run these crowdfunding apps and these real estate trusts and funds will have experts who can pick good deals in the market. Plus, you'll have the collective bargaining power of larger sums coming in. You normally have much shorter term valuations and quicker access to your funds. And I think best of all with REITs is that you can diversify across not just a city, but across an entire sector, across an entire market. You could, for example, be investing in US logistics real estate, you know, the Amazon warehouses and all these growth sectors that are coming in. Or it could be a very narrow sector, luxury real estate in Dubai, or hotels or something like that. But either way, you can spread out very nicely. So it's a very nice way to expose yourself to different things in real estate rather than just buying a unit. The downside, however, is that the funds themselves need to have large cash reserves. Now, the reason they need large cash reserves is because if you're putting money in, taking money out, you might go in for a year, then come out again. They have to have liquidity to pay you, because they can't keep selling assets they've just brought just to pay a couple of investors. So that means they don't often always deploy the entire amount of cash they hold, which means often you'll find these crowdfunding and real estate investment trust funds and apps will actually be holding sometimes up to 15-20% cash, which is often not always deployed. Sometimes it's just sat in a bank. Occasionally they get a bit of interest on it. So it's a little bit of money that's potentially lost, which they have to have. And of course, if everyone starts trying to pull their money out of a REIT or a crowdfunding app right away, that can actually cause them to have to sell off their entire assets, and that would close down the fund, which can take a long time. And if there's pressure on them, it could come at a time when perhaps it's not good to sell, which could result in a loss. Another downside with REITs and crowdfunding is that some are only valued monthly rather than sort of weekly or bi-weekly. And often you'll have to hold these on some sort of a platform, particularly if you're an international investor or an offshore investor, which means you might need to pay platform fees as well. Although you can line those up and compare those with the fees you might pay in tax and land registration and all the rest of it from direct ownership, and it may come out being about the same. But it's important to keep that in mind. The last one, and one which I'm really surprised a lot of people don't know a lot about, and I love these. There are a lot of caveats to these, of course. Something called a loan note. In some of the more mature jurisdictions, the legal systems that are in place are very robust, and you can take legal contracts with developers and with certain real estate companies where you're essentially lending them money to deploy for their projects. Now, this could be one project or it could be multiple projects. The loans typically run for 1 to 2, sometimes 3 years, and they pay you fixed interest. They're often tax-free, which is surprising to a lot of people. So you could, for example, invest into the UK market as someone residing in the UAE, and you wouldn't pay a penny of tax. or you'd have very low tax in some cases, because debt normally isn't taxed properly. It's only the profits of it. You've also got a lot of similar advantages to crowdfunding and REITs with loan notes, which is that you can spread yourself out across different markets, across different sectors. You could pick a couple of developers that do completely different things, and then your exposure, your diversity is increased, which decreases your risk entirely. One of the most powerful things with loan notes, though, is that they're more accessible. So in some cases, loan notes you can get into for 20, 30,000 US, or the currency equivalent, which is obviously a lot less than going into direct property. There are some cons with loan notes, however. They are dependent on a single developer. Each loan note will be issued by an individual company. And that in itself could potentially be a risk if you're investing with a particular company. They often also don't have a real sale value. So once you're in for the term, you tend to be stuck there, which is 1, 2, 3 years, etc. Although that, of course, is a lot shorter than the life cycle of most properties. But overall, they require a lot more due diligence, and you have to really know what you're doing, and really do your background checks on who's behind them. But there are a lot of issuers of these loan notes that have been around for a very long time and have consistently delivered returns. Some of them come with different layers of insurance and protection as well. There are some good guys in the market, without a doubt. There's also a lot of newer players that have come in recent years, because there's a higher demand now for fixed income. And not to say that they're good or bad, but because they're new, they just don't have that track record, which could be a risk. So in closing, you've got 3 ways of getting into real estate. One is you can buy directly, which is you just go and buy your property from a developer or from an existing property that you've seen that you liked, or you can go in directly through a crowdfunding real estate investment trust, or through a loan note as well. You've got different kinds of market diversification going on, and it's important to spread yourself out, not just by sector within real estate, like residential, commercial, tourism, etc., but also by jurisdiction as well. Spread yourself out across borders. It's much easier to invest across borders these days than it's ever been. Make sure you do your due diligence. If you're working with an agent or with someone like myself, for example, ask lots of questions, get everything in writing, ask for the due diligence packs, do a bit of digging around as well, and make sure you're 100% happy. Don't get swept up in the hype. There's often a lot of hype with property. It's a very exciting asset, and rightly so. It's a very good asset, but make sure you're looking very carefully at that. And that really leads me to the last point I'll make before I open up to the Q&A, which is emotional attachment. Property is psychologically very, very comforting, very comforting. But as a result, it can also cloud our decision-making process. And so it's important to make sure that you take a step back and you're a bit dispassionate when you're deciding about buying a property to invest in. And with that, I've kept it as short as I can, and I really appreciate, again, your time today. I'll open up the floor to questions.